Okay, let's speak a little bit about the toolbox, a little bit more, our risk management toolbox. We've talked about risk-reward ratios and stop orders. We've talked about buying options that give us a guarantee on which we could sell. This is extremely effective, costs a little money. Hedges are where we buy one thing to offset another, and this is the one we're going to be talking about in this particular session. I'm going to scroll down here to where I can maybe find some fun graphics, and we do a lot of this in the Ultimate Options class, ton of this. And as these things get more and more complex and our trades get more and more involved and fancier, knowing how to hedge is a huge thing. And the reason they call it a hedge is, this is a hawthorn bush, a little hedge row here. There's a bustle in your hedgerow. Don't be alarmed now. But you can see the thorns in this thing, right? And it's kind of a bushy bush or tree, and a hawthorn can grow to a height and spread of about 6 meters. So you got to keep these trimmed, and they just get thicker and thicker. This is a 400-year fence. So in the old days, storm the castle, shoot, 6 meters thick, 6 meters high. In the old days, these hedges were pretty cool natural fences. If you go out and dig a hole in the old days and you put a fence post in there, that thing will rot so fast. They didn't have pressure-treated lumber in those days. So this was really about protection. So you have this idea of, instead of saying protect your bet, they say put a hedge around your bet. And the idea of hedging was born. Well, let's say that we're under attack and we need to have a hedge here. We got to have something to protect ourselves. And what happens when we get a position that starts to just get out of control and it becomes a threat and it's not going the way we wanted? Think about it. We have fundamental analysis and everything was happy and we had this data, it was going well. We had technical analysis. Everything was happy and it was going well. We had the cash flow and everything was happy, and then all of a sudden it went from happy to now you're wrestling with something that feels intimidating and bigger than you are and all this type of stuff. So I have this saying. I don't have very many quotes that are mine. I have like one or two. If you go to WikiQuote, I have none, so I guess I'm not worth quoting, which is fine with me. But I have a saying that I give to my students. It says, look, always be mindful of your money. So one of the things we're going to talk about in this video, in addition to hedging, we're going to combine them, is the idea of keeping your stuff small so where your money works for you instead of having it get out of control. Look, keep it working for you, keep it small, and make your money work for you. Always stay bigger than your money. Never let your money do this to you. And there's some wisdom in that, I think. Always remain bigger than your money. What that means is two emotions. Greed does not overwhelm you. Oh, I got to get into this thing. This is my windfall. This is my chance. Relax. Stay bigger than that. Look, keep the attitude. There's so many more important things in life than money. There's family. There's health, right? There's joy. Money helps with some of those things, but it can't ever get bigger than those things. So keep this guy in his place. Don't let him grow into something like this, okay? Always remain bigger than money. Now, if he starts to grow and he starts to get out of control and he starts to look, and he won't obey you anymore, what would you do? Well, you know what? Go out and find a buddy here. Say, okay, you want to make this guy second guess, right? So if you have a position that's misbehaving, right, this is the ideal position. This is a misbehaving position. Well, if this guy starts to misbehave, he's bigger than I am. I can't tame him. Great, I'll go get another position that's equal and opposing to him and neutralize the threat. See how this guy, look, he's second guessing. I say, oh, he's got a buddy. I'm not the only trade in his life. He's got someone to help me. And the word truly is neutralize. If you do that, well, now you're relaxed. And if you have if your misbehaving position is both small, so we have this idea of position size, and neutralized, well, isn't this cute now? Isn't this cute? So again, the lessons are always stay bigger than your money. Don't let any position size get large enough where it can bug you, right? Keep these position size small. What does that mean? We'll talk about it. And if this guy starts misbehaving and gets out of control, guess what? Okay, I'll go get another position. Show him what's up. Show him what's going on. And if they're small positions, this can be easily managed, okay? Very easily managed. So with that, let's take a look at a rare basic hedge. And this is the part of the reason we do this is to prepare you for the Ultimate Options class. This is a primer. And if you begin to understand this on a small level, when you get in that Ultimate Options class, you'll be, oh yeah, I remember this. Okay, I got a good foundation. Let's say I buy a stock at $66. And, let's say I just buy one share. At $66, right there, 66. So what would that look like? Well, in fact, let's do 100 shares just for fun. 100 shares, that'd be better for this scale. So that means if it goes to 67, I'd make $100. If it goes to 68, I'd make $100. If it goes to 69, I'd make $100. But if it goes against me, this would be scary, right? So what side is the monster on? The monster is on the losing side. In other words, the more I lose, or the more the stock goes down, the bigger this monster becomes. Do you see that? The more I lose. At $61, I'm down $500. That's a pretty big monster. So I can see that the further down the stock price goes, the bigger the monster gets, the bigger my headache gets, the bigger the problem with this trade gets. So, how do you deal with that? Well, watch. I'm going to flip this over. What if I went short? You would never do this. You just sell and get out, but this teaches it very well. What if I went short 100 shares at $66 a share? Well, if I'm short, remember that's the opposite, my risk if it goes higher. So now, if I borrow 100 shares at $66, and I have to buy at 67 to pay it back, I'm down $100. And if I have to buy at 68 to deliver, I'm down. And so all of a sudden I get this graph that is equal and opposing this graph. They're equal and opposing, aren't they? So what's interesting is if I draw a line, let's just use a blue pen right here, is on this graph my monster's on this side. Watch, on this graph, let's get on 66, on this graph my monster's on this side. So if I was in both of these trades, let's just see what would happen. Okay, let's see what happened. And let's go towards the downside. If I was long and went from 66 to 65, I'd be down $100 here. But if it went from 66 to 65, I'd be up $100 here. So if I'm up $100 here and down $100 here, these two trades together, where would I be at 66? I'd be 0, and at 65 I'd be 0. In other words, I have a neutral position here. I don't have no position. If I have no position, I just get out and sell, right? But I can keep these stocks. Now watch, let's say it went up 67, well I'd be up 100, but right here if it went up, I'd be down 100. So guess what this does on everyone you want to do that math with? Look, you want to go to 61, down $500. Great. You want to go to 61, up $500. So you want to go to 61, we're neutralized. Now, of course, we would never trade this way. It's ridiculous to have long and a short. You just get out, right? You say, look, I'm out. But what this shows is, more importantly, is this monster looks like this monster looks like this, and I've created equal and opposing trades, which neutralize my position. I'm not going to make any more money than I have right now, and I'm not going to lose any more money I have right now. Well, I'll tell you, when there's panic and there's sudden change, and there's a 9/11 or there's a whatever it is, it's nice to get here and say, look, I'm just gonna set up trades to where I'm not going to make any more money in this turmoil, but I'm not going to lose any either. I'll ride out this storm without massive losses. I'm just going to flatline the thing. I'm going to take away my immediate upside, but I'm also going to take away my immediate downside, and I'm going to neutralize this with opposing monsters right here. And this is one of my favorite ways to hedge, favorite ways to manage risk. It's absolutely awesome. So this is important because if you start to grasp this, It'll help you learn. Now, this is an advanced, it's intermediate. It's an intermediate. It's out of the scope of the 4 pillars. I probably shouldn't even bring it up here, but it's important to know about now, so we can look at so when you hit ultimate options, you'll know what you're doing. So let's go into our simulated trading account, and let me bring up a chart here off screen. Then I'll bring it over onto the screen. Let me get nice and organized right here. Starbucks. That'd be a good one. Let's do Starbucks. So in the Mentor Club right now, we have Starbucks. And let's detach this. And right now in the Mentor Club, we got Starbucks. And let's do our 4 pillars. A little bit of struggling on the economic front. Fundamentals. Oh, boo. Bad fundamentals. Okay. Lower highs. Right? Lower highs and lower lows. That is the definition of a downtrend. So fundamental analysis, maybe struggling a little bit. Technical analysis, right? Technical analysis. TA, struggling a little bit, okay? So pretty rough. Coming into, had a little earnings here, and, here we are. So if our fundamental says tough and our technical is enough, what would our cash flow position be? What type of cash flow position might be attractive with us? Well, if we want to make money going down, we'd have 3 things we could do. We could sell a call, because if it's going up, you'd want to buy a call. If it's going down, sell a call, and as it continues to go down, we collect the premium. But boy, a naked call, that's pretty risky, so we'll cross that off. Okay, short the stock. Well, if we short the stock, it goes down, we'll make money. If it goes up, I have infinite risk, so let's not short the stock. How about this? How about buy a put option? Maximum risk is premium paid, so we don't have infinite risk. Both of these, naked call, short, have an infinite risk. Let's buy a put, and we have fixed risk now. So we buy a put. So now we have a cash flow position of saying, look, we're going to buy a put. So we have a long put. Okay, just like we did in the very last section of the cash flow videos. And so now the question is, all right, what's my risk management strategy? What if all of a sudden they start selling coffee again? What if this changes to an uptrend? This long put would become a liability to it. It would hurt me. So what's my risk management strategy? Do you see this? Kind of interesting, 4th pillar. So this would all be fine and dandy, but without that 4th pillar, boy, you're at risk, because what if this stuff changes? Well, if this stuff changes, your position must change. And so what would be, again, our risk management? So let's look at a risk graph of this trade on Starbucks. And this is in the Mentor Club right now. And we said, look, we think it's going down. It's gone down a bit. And we see, okay, well, where are things right now, right? Where's the stuff right now? And we see that we're up. I'm going to circle this with time decay included. We're up in our little box here about $24 or so, right around there. Let's see if I can make this even wider to be seen. Wide, open wide. Well, I like that much better. So let's circle that again. Let's circle it in blue. This is our cash box, so to speak, right here. And right now, if I go right to where the stock is today, let's move this price slice. Just get it right on where the stock is today. I can see that I'm up $24.90. So let's get a calculator and put that in. Okay, let's put that in, see what we get. $24, let's get it right on. 24, that might be, I'm trying to get it right on there. $24.90. That'll be close enough. So we're going to go 24.90. That's how much we're making right now. If we got out of this trade, we're going to make $29. It's a small trade. It's an example trade. Hey, if you had 100 of these, you'd have $2,400. If you have 10 of these, you have $240. We got one of them, and so we got $24.90. Okay. Now this is really cool. You can see that where's the monster? Where is the monster? Well, the monster's over here. So let's draw our red monster. Rawr, rawr, rawr. Ooh, I'm an artist. Look at that. If this stock goes up to 84, 85, 86, 80, look at how we're losing. We'll lose 100, 200, 300, 400. We'll lose if it goes up. So here's our monster. Right now it's pretty calm and small, but if we get in here, this monster, he's going to get pretty big. He's going to eat up all our cash. So the question is, what kind of trade could we make to have a monster that could fight this one? Watch this. Let's pull him off and get rid of him. Let's put him on. Well, look at this. I have a trade here that's almost the same slope. Let's make this the green monster, right? So over here, I'm going to make the same guy, man. Same type of monster over here. Rawr, rawr. And now with this trade that I've got highlighted, if the stock goes down, I have a monster. But you'll notice when I switch this back is they're not exactly the same. See, this one is a stock, but see, this one right here is an option. And if I bring in a little time here, see how it stops and it starts to curve. In fact, if we look at this from this standpoint, this monster gets pretty tame, in this area. We're still down $500, but he gets a little more tame. And this one but watch in the first dollar or so what happens. Why did I choose 78? Well, you'll notice here that I haven't got this highlighted. You'll notice that with this one highlighted right here, this long put, right, that it has at this point at 83.94, where it is right now, 83.94, where it is right now, it has a delta of negative 78. Negative 78. Well, guess what? That tells me that if I get a delta of positive 78, it will offset that delta of negative 78. And if I do this right, I can get this almost to zero, like 0.45, right? So here I have positive 78.0145. Here I have just a nice 78. Positive, negative, neutralizes. Now look at where I am. If I, right here, watch where I'm at. Right here I'm up, $4 or whatever. Okay, great. If it goes up $1 from 83.40 or 83.94 to maybe 84.94, look at that. It doesn't change much. See, I'm losing a little bit. How about down here? I'm losing a little bit. So I've neutralized this position right here. And what's really cool is, notice now, if it goes up like crazy, there's no monster here. I'm making lots of money. Oh, and now if it goes down like crazy, I'm making lots of money. But I've neutralized it right here in between so they cancel each other out. So now I can sit here and say, oh, this is great. If it goes up, bam. If it goes down, bam. You follow that? Now I've got a little time decay risk in here. But this is the 20th of December. This is a ways out. So at least I can sleep tomorrow as it goes in, because in one day, beep, doesn't even matter. See, beep, doesn't even move in one day. In fact, in 5-6 days, doesn't really matter that much. So you'll notice that I'm profitable on this whole graph here, anywhere it goes. Why? Because I use something called delta hedging. I said, look, what's the delta of this put? And we'll learn more about delta, gamma, theta, vega. We'll learn all this in Ultimate Options. But right now I'm introducing delta. If this has a delta, which has to do with price movement, of negative 78, meaning that if we go up $1, we lose $78. That's really what that says. If this were to move up $1, we lose $78. Let's see if that's true. Let's try and get this on there pretty close. 22.17. So what would $78 be? Maybe negative 50 or 60, somewhere around there, 58, something like that. So if we go up $1, what are we losing? Yeah, about the same, about 58. So it's about a $78 move there. What about here? What if it went up one? Well, if we're at about $20 now, that $1.78, that'd give us just under $100. Let's try this. Just under $100. How about right about there? It's on this side, 70. So 83.94, 82.94. Look at that, about $100. About right there. So I have a downside here, that gets nasty. I have an upside here that's great. Delta hedge. I take that number 78, that slope of 78. I get a positive slope. I know that one share, right? If I buy one share and it goes up, one share, $1, that's $1. So if I need $78 to hedge, I buy 78 shares. Bam, neutralize. See how it's flat. So now if there's trouble, I not make as much. Well, I know I don't lose as much if it goes there now. I don't lose as much, and maybe I don't make as much, but at least I'm neutralized and I'm not losing money. I would say that in turmoil, which position would you want? One that it could take off and lose you money, or one that no matter where it went, you'd still be okay? That is the power of delta hedging. Now I'm going to pose a question. Does your 401k have that? Does your 401k have that? If the market disintegrates, does your 401k okay either way? Sometimes in turmoil where things are rough, it's a great skill to have to know how to come in here, flatline that baby. And I will just tell you, the day is going to come where you're going to be excited about these dividends already, and you're already excited about this. But the day is going to come where you're going to be in some iron condors and some butterflies. And I mentioned the ad, I think it's an E-Trade ad, that I didn't like because, it makes you feel like the odd man out. This person walks into the coffee room and there's two fellow employees there, and the person went, "What are you guys doing?" "Oh, I'm doing an iron condor on E-Trade." "Oh, I'm doing a low commission iron butterfly on E-Trade." "Oh, I want to learn how to do that too." That's kind of the commercial. Well, great. I will tell you this. I'm at the point now where I don't think I would teach someone how to do an iron condor and iron butterfly until they had a knowledge of this. I receive emails all the time. I had one from a wonderful gentleman. He says, "Andy, I got into these. These are high probability trades. I was making all this money. I did two things. I didn't position size. I did not position size, and I just went with all of it. Next thing you know, sure enough, it got this. And I was so proud of the student because he took it on the chin, or she, took it on the chin, said, "You know what, that was my bad. I didn't listen. I'm going to be a better student." Well, great freaking job. Guess what? What if I told you I'd done the same thing as an early trader, that I let this get away from me? So learn from those mistakes and say, I'm not going to write Andy that letter. I'm going to say, I'm so glad I learned how to delta hedge first, so when things get nasty and things get in trouble, I can at least keep it from getting worse and breathe for a while, right? So it doesn't get any worse on me, and I can put this thing on ice and acid neutralization and get it done. So that's awesome stuff. Now, so that's the idea of delta hedging. And a visual for it that I really like is, okay, great, create one trade that can combat the one that's getting away from you. And then if your position size is right, it's neutral and you're gravy. Okay, let's talk about keeping this guy small here. And the way I think I'll go about this one, let me come up, is when you talk about position sizing, okay? The best one I like is the casino, and I probably should never use a casino and even touch that correlation with investing because it's not the same. One thing casinos do is if you ever go to one, I'm not much of a gambler. I value my money a lot, so I don't play. But if I were to play blackjack and I go to Vegas and I sit down at the blackjack table and I pull out a $100 bill that I figure I just will light on freaking fire, which you shouldn't do. Let's say I want to light on fire, so I say, the guy says, changing 100, and he gives me chips. And I'll notice that there's a minimum bet, but there's also a maximum bet. It's called high limit 21 or high limit poker or high limit Texas Hold'em, where the amount of money you can bet, there's a limit on it. If you have no limit, you better be playing poker because if you have no limit as a casino owner, you're in trouble. So what happens is there's this thing called martingaling. And what martingaling is let's say I'm playing a casino game and I bet $100. Well, let's just say it's this way. Let's say I bet $1 the $1 minimum bet, and let's say it's $100 maximum bet, something like that. Why would the casino, if the casino has the advantage, why would they care how much? If they have a mathematical advantage every time, why take a limit on there, right? If they win 51% of the time and I lose, or I win 49% of the time, well, why wouldn't you want to max that out? Right? Wouldn't okay, bet $10 million over and over and over again. You'd be fine. Well, the problem is people can martingale, and how that works is this: you bet one, and you lose, so you're down $1. They just take it, right? And down $1. Okay, the next thing is you bet two, and you double that bet. You bet two, and let's say you lose that. Okay, great. Now you're down. Watch this. Now you're down $3. Okay, great. You bet four. Okay, you just keep doubling your bet, and notice notice what's happening right here is I'm betting the same amount I've lost. So I'm just doubling this, okay? And I lose it. Okay, so now I'm down this $4. So total, what am I down, right? I'm down 1 here. Now I'm down 3 here. I just lost 4 more, so now I'm down 7. Does that make sense? Right now I'm down 1. Right now I'm down 3 because I bet 2. I bet 4 more, right? So now I'm down a total of 7. Okay, let's keep going. So I double and I say, okay, I bet 8, and I lose that. Okay, I lose that, and so now I have to add 8 to my loss. So now I'm down $15. Okay, okay, great. Now I bet 16. Now see how many I have to lose in a row to have this not work. So now I bet 16, and sure enough, I lose again. Right, I lose again. And I lose it. So 16 plus 15, I'm down 31, right? So I'm down $31. Let's just keep doing it if you've never done this. Let's see, never done math like this. Okay, 16. So now I bet $32, and I lose it. Okay, I lose it. And so let's see. Now I'm down, what would that be, 63? So now I'm down $63. Now, what would be interesting here is if I'd have won at any time here, I'd have gone back up. If I'd have won 2 gives me 4, great. That takes out the 1 and what I've lost. Oh, great. 4 gives me 8. Well, great. I have 4, and I only lost 3 here, right? Oh, 8 gives me 16. Well, I'd only lost 7 here. And so you can, this is called martingaling or just adding to it and throwing away the problem. So I could just keep doing this until I win. Let's say that I bet 64. Let's say this is the winner chicken dinner. I bet 64 and I win. So they pay me 64, right? Well, guess what? That's the 64 I had on the table new. Those are my winnings. That takes out all of the losses that I had, every one of them, and I'm up $1. So if there were no table limit, I could just keep doubling and doubling and doubling and doubling and doubling until I finally win. And someone's going to sit at the table and say, well, eventually I'm going to win. So what they do is they say, They say, all right, let's say I lose the 64. Okay, well, guess what? 64 and 64, that'd be $127. And guess what? Now I can't do it anymore because I cap out at 100. I can't make up that with a win because now if I get paid 100, guess what? I'm still down 27 bucks. So a winner's graph of martingaling at this casino looks like this. Win, 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 loss. Win, 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 loss. Win, 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 loss. So guys get really excited in these instances, and they get bummed on the one hand that kills them, and they can't go higher than that. And that's what causes this graph and makes the casino so they can't lose. Let me say that again, or so they can't lose over long term. So if you were the casino, would you want to have this limit to prevent someone from beating you? Yes, you would. Well, if you were an investor, would you want the market not to beat you up? Yes, you would. So your limit is the size of your account, right? Or the size of the market, whichever is bigger. Probably the market would be bigger. And someone with a large position size, it can kill you. So we keep the position size small, and we say, look, we're going to put a limit on how much of our portfolio we're going to risk, just like these casinos do. We're going to put a limit on it. And I will not, since I don't give financial advice, I will not tell you what that limit should be for you. That's for you and your advisor to discuss. I can tell you what some popular choices are. Some people say, you know what, I don't want to risk more than 1% of my portfolio. So that means if I have $100,000 in any one trade, I wouldn't risk more than $1,000. What does that mean? Well, let's say the stock is $100 and you want to buy 100 shares. Okay, that's $10,000. You think the stock's going to 102, and 99 would be the stop loss. So now if it goes to 102, great. You make a couple $100, but if it goes down here, you don't, right? So that's how that stuff works. Or 1,000 shares, let's say, or whatever it is. Right here, I want to make sure that this distance, whatever math is not more than $1,000, right? If I have a 1% position size. So if you have an account with 100,000, you say in any one trade, I don't want to lose more than $1,000. And whether you make sure that happens with an exit, make sure that happens with an option, or make sure that happens with a hedge, or make sure that happens however you want, you say, look, I'm not going to do that because now I'll have 99,000 to trade with to live another day and trade. That's important where we talk about non-correlating assets at this point, because if I have Morgan Stanley and I have Citibank and I have U.S. Bank and I have Visa and MasterCard, these are all financial companies, and I'm not non-correlated. These are very much correlated. If the financial sector dives, I'm losing all. So I don't know if I like the word diversification because that still doesn't help systemic risk, but gold is probably going to behave different than the S&P 500, right? And oil will probably play out differently than the US dollar. So by trading different non-correlated assets, I can kind of protect myself a little bit from that. And if in each investment I have a limit, right? I have a limit to what I'm willing to lose. Then that's an important deal right there, right? If you look at a roulette table, it's important because you have 18 spaces that can win, 18 spaces that can lose, and where they gain the advantage is this 2 green. Same thing, double down, double down, double down, double down. But because they put that table limit on there, you can't do it in roulette. You can't do it in blackjack. A limit takes and manages the risk of the casino, in short, right? A limit manages the risk of the casino. Very, very important. So, maybe you have a 2% tolerance or whatever. The better trader you are, the higher this might get for you in how much you feel comfortable in losing. So here's your goal right here. And this is the last thing we're going to say before we finish out this pillar. Okay, it's the last thing I'm going to tell you, so it'll be in your mind forever. Okay, I never want to get a letter from you where you had a trade that blew up your account. Ever. Okay, this can't happen if you do a couple things. Number one, if you're practicing on paper, you won't write me a letter saying I made a lot of money, but you won't write me a letter saying you ever lost a dime. So how much time should you practice on paper? The answer is, and this is the worst answer ever, but it's also the truthful answer, so I'd rather give a bad truthful answer than an exciting untruthful one. The answer is it depends. It depends on your temperament, depends on how consistent you are, it depends on all those factors. So when is a person ready to move from paper? Well, I don't think, let's pull this off and draw it a little bit. I don't think the transition from paper to real money looks like this, where I trade on paper and then one day I'm just completely awesome and now I go to real cash. All right? I'll tell you, how about a graph that looks something like this? Okay, maybe something like that, where we go paper for quite a while, and we go cash over here. In fact, you should probably always have a little paper going. I do, to where slowly you start transitioning from paper to cash. So on your first day, you're still trading mostly on paper, then cash, and then later on, well, mostly in cash, but always a little paper, right? This one would make more sense, I think, but and only you know. So what are some clues? Well, if I'm on paper and I know how to delta hedge, and I've had 5 or 6 trades go bad, and I've delta hedged every one, that's a clue. If I've had stop losses where I've minimized loss a bunch of times, that's a clue. If I've traded long enough to experience both a bullish and a bearish market, that's a clue, right? That can be a long wait, so I understand. You probably don't want to practice on paper for 10 years. I get that. But the point is it doesn't make sense to go with live money until you've had experience losing and how to manage those losses on paper. So I would say the first thing that would prevent you from writing me a letter saying, hey, Andy, I got in trouble with this, is, well, you didn't leave your paper trade account too early. That would be huge. Now, is that exciting to hear? No. It might be if you're smart. You say, God, this is cool. I get to learn this skill without having to risk. Try that in real estate, business, or oil. You know, try practicing paper trading oil. Do you know how long it takes to drill an oil well and see if you would have been right or not? Paper trading is a great way to learn a skill with no risk, because it's on paper. So paper trading is a huge thing. Okay. Next, position size. Okay. If you've only risked 1% of your account or whatever you and your advisor decide, it's going to be pretty tough for you to say, I had one trade that blew up my account, right? If you have an option on that trade, if that thing's hedged, whatever, tough to blow up your account if your position size is 1%, right? Tough to do. I won't get the letter if you do it. Well, it'll happen because someone will go right, get greedy, go from paper to real, because they make a bunch of money on the paper in a week, and like, well, I could have been this for real. And what got them? Their greed got them. They didn't remain what? Bigger than their money. They did not, what did I say? Always stay bigger than your money. Don't let this little guy grow on you. Stay bigger than your money. Okay? Keep him small. Don't let him get like this. That's not 1%. That's 1% or 2 or whatever you decide with your broker. Okay? To position size. Learn how to hedge. Okay, more. Now I gave you a lesson, your first lesson on hedging for a basic 4 pillars course. As you get further into options, I think the most popular in the Ultimate Options course, the most popular one is number 326. Check this. I don't want to show this to you because I don't want to scare you because you're new, and you'll think, oh my gosh. But you also might think, wow. So I give the same little monster analogy that you've learned, but man, then we go into sick, ridiculous, awesome, learning how to hedge, way like iron condors and way cool stuff when you're down on how to get that stuff back. See, and so there's so much more to this with probabilities and and we go into ridiculous, awesome detail on how to deal with this, right? On how to deal with these little monsters. And, there's so much in this class, man. I mean, it is just killer to learn how to delta hedge all this stuff. So don't show that to intimidate you or scare you at all, but it does show you, that there's so much you can learn about this. So let's go back to our list again, please. Paper trade. That's our commitment, paper trade. Can't lose any money if you paper trade, right? Okay, next, position size. It's the shortest pillar, but it's the most important one. Learn how to delta hedge or to generally hedge. Right? What's in our toolbox? Puts and calls that we'll just call it protective options. Mark Cuban can't blow up his account if he's got the right to sell high when it goes low, guaranteed in paper and writing, right? We want to learn exits and risk-reward ratios, and we want to be diverse. And all that stuff is part of what? It's part of our toolbox. Did I grab the wrong one? It's part of our investing toolbox, our risk management toolbox, all that stuff. So we talked about hedges, non-correlation, position sizing, risk-reward ratios. It's a short pillar, but I'll tell you, those are great things, understanding systemic versus non-systemic risk. Now, I'm going to give you one more, and I've done this thousands of times. You might have even seen me do it. Let's readjust my chair here so I can do this right. When it comes to risk reward, we might have already done this, and if we did, that's fine. It can be redundant. I don't care. Is over here in red, we're going to put risk. Okay, risk. These are such great investing principles. Hopefully you can feel it. You can say, you know what? That's a heck of a toolbox. That's hopefully what's happening. Hopefully what's happening is you say, you know, if I did this stuff, this toolbox stuff Andy's talking about, if I did this, man, that would help me manage my risk a lot if I learned those skills. Yeah, absolutely. So traditional thinking, and I can't disagree with this, by the way, is we look at reward over here, and we have this risk-reward type of deal over here, risk-reward. And that graph probably goes like that, right? The more reward I want, the more risk I'm going to have to take, right? Like that. Okay, so let's say we're starting with something higher risk. Well, I think there's another risk to consider. How would I reduce that? If this right here is a naked call, and why would you want to learn how to do a naked call? See, a lot of people say, oh, never teach naked calls, never teach naked calls. Well, why wouldn't you teach someone to skydive? Look, if you want to skydive, learn how. Well, that's just too dangerous. I won't do it. Well, wait a second. Think about this. We were talking about infinite return, right? We're talking about trying to get our cost basis down. Well, if I buy a stock and sell a call, I'm covered. If I buy a long-term leap and sell a call, one strike out of the money, I'm covered. And if I sell it naked, I'm not covered. But guess which one costs the least amount of money and gives the best return if you're right? The naked one. If you go back and you look, let's take a picture of this so I don't lose it. If you go back and you look at that, at our the one I wanted one trade that would really give a good example of how this stuff worked, right? So I used KHC, and the reason I used KHC is number one, well, I liked it, and who knows, maybe I'll be wrong. Haven't been so far. But Corey and I traded KHC in our I have it both in my personal account and also the joint account I trade with Corey as a team. And in this period of time, you know, where we've developed this class, you know, we've been really talking about this period of time where it's gone relatively sideways, dipped down a little up. And it's pretty much right now where it was when I started, right? Pretty much hasn't gone anywhere. Well, our cost basis for this stock that right now is a $33 stock is $22.31. That's our cost basis. So out of this 33 that we put in, it's already given us back, you know, $11 or so, right around 11 bucks. That means that if we keep doing it at this pace, in probably 18 months, we'll be zero money in the deal. It's paid us back everything we put in. At that point, we've gone infinite, right? We've gone infinite return. Well, how did that happen? Well, certainly I sold in March when this happened. The first thing I sold were some cash-covered puts, right? But I also sold what? A naked call. I sold a naked call. And part of the reason that's so big is because I went naked. Now, I didn't teach you how to go naked because this is an advanced deal. But if I want to get to that infinite return closer, if I learn how to do this and I'm confident I can do it with a degree and margin of safety and a good position size, that's attractive to me. Those are risks that I'm absolutely willing to take. No, they're risks I'm willing to manage. I don't know if I'll just take those risks, but I'm willing to manage them. So as we start getting into, as we start wanting to get closer to infinite return, having no money in the deal, and we want better and better rewards that pay us at a higher rate, we go up and we start taking more risk. Now, what else makes this a risky trade? Most people wouldn't have made this trade because up here, this is hilarious. If you go back and you go and you can get some dates on analyst recommendations. Up here, go back a little further. Well, heck, even up here when it was in the 70s, just a little bit before here, when it was in the 70s, people were saying, buy this stock. It's a great company. Buy. The moment this happened, you look up where the analyst ratings went here and here, they were recommending sell the stock. So this is what I think is funny. They're recommending you to buy at a high price and sell at a low price. That's not a recipe for success. But if everyone in the world around you is screaming, sell, 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 everyone's screaming, sell. If you're going to say, no, I might buy it right here, I'm going to sell a put to buy this right here, you got to have some risk management skills. You got to be pretty confident knowing what you're doing. Because this stock right here, pretty risky stock. A lot of debt, SEC investigating them, all this stuff going on, right? Basic fundamentals not bad. But there were some fundamentals, but Buffett's still in. So you're going to team with Buffett going against every single other analyst out there, man. Every one of them saying this is a dog. They got too much debt. Their brands are antiquated, right? Everyone wants health food now. They don't want ketchup. I disagree. I know I want ketchup. Bring on the mac and cheese. Oscar Mayer wiener. I wish I was an Oscar Mayer wiener. Then everyone would want a piece of me. Naked call. Now, so let's say I want to do this. How can I get the risk back down? How do I do that? Well, you do what you're doing right now. So great job. Is the more education you have, you get that risk back down a little bit. Now, that might be not perfect. So let me, cover my butt there. Is the amount of risk in the naked call doesn't change just because you studied. Okay, that's not what I'm saying. The amount of risk for me to do a naked call is infinite. That's the risk. The amount of risk for my mom to do a naked call, infinite. So the risk is still high. This mark didn't change, right? The amount of risk, mark didn't change. But as I get education, I feel like this happens. For example, if I trade a naked call and my mom trades a naked call, I feel more comfortable with me doing it than her. Not that the risk is any different, it's infinite risk both ways. But knowing how to hedge, knowing how to delta hedge, knowing how to position size, knowing how to do fundamental technical analysis, knowing how to risk manage, I feel better with people learning that stuff. So I've never taught, advanced naked stuff. I've always referred to other people. But we had so many people saying, Andy, we like the style of the Cash Flow Academy. Why don't you teach an advanced options class? So after about 4 or 5 years, maybe longer, I broke down. And a couple years ago, we built the Ultimate Options class with the idea of, all right, let's give people the education if they'll have the discipline to follow it. So that's it. Hey, I feel, I'm not like a sappy guy. Well, actually, I can be. But I got to tell you, I'm so proud of you because guess what we get to do right now? This is pretty special for, you see you see someone you love graduate. It's a big deal, right? It's a big deal. You look at the education continuum, and I'm just asking if, after this 4 pillars class, did you get dumber? Or did you get aware of more? Did you start learning more? Are you ready to move into proficiency? Where are you on that continuum? Do we move? Do we make some progress? Does it feel good not to be here anymore and to have these illuminations? I hope it does. I hope you understand that idea, the traditional view versus my view. I can't argue with the traditional view, but I will say that this is really centered on what we would say investment. This is for people who care about the investment. This is centered on the investor. That if someone says, is gold risky? I'd say, well, yeah, but how much do you know about gold? And if they say none, I'd say, well, now it just got really risky. If Buffett comes to me and says, investing in business risky, I say, yes, Mr. Buffett, it is. He says, I'm thinking about buying a business. I say, well, for you, I think you can manage those risks, buddy. Go ahead, Warren. You don't need to ask my permission, right? You go ahead and you do it, right, like you would. And so I congratulate you and I honor you. And I love you. I love all my students. I don't mind saying it. Congratulations, you've just completed risk management, which also means, if you can believe it, which also means you've now completed, for the first time, maybe the second time, maybe the third, I don't know, but you've completed this round of the 4 pillars of investing. Great investors know fundamental analysis, technical analysis. They know cash flow, and so with that, I honor you, and I honor you, and I praise you. And if there's anything we can do, please reach out. We love when people email us with questions. We'll never tell you what to buy. We'll never give advice. We never break that rule. But if you want clarification on something that's been taught, well, you know what? By all means, reach out to us. Again, congratulations. Let's put that in theater mode so it's official. Congratulations on completing risk management and also the 4 pillars of investing. And we'll probably throw a couple bonus videos on this. I'm thinking about maybe doing something with Corey to help people understand how the coaching works. If you went through this round with coaching, I imagine you're sitting there saying, yep, I get it. I know why I did the coaching. If you did this round without coaching, do the next round with coaching, right? Call them up, say, you know what? That was awesome, 4 pillars. Wonder what the difference would be doing it with a coach and how much better I'd be. Well, one way to find out, grab a coach. And then if you've done it with coaching and you've completed with that, see what you can do in terms of ultimate options. You know, that's not a light undertaking. I wouldn't say that it is. Give yourself at least 6 months to a year to get through that class. That's how big it is. And it's designed to really, bring people into more proficient status on the education continuum. So with that, I'm Andy Tanner. Wonderful to have shared this experience with you. We'll see you next time. Always remain bigger than your money.